Well, let's just talk about some of the reasons. It seems as though the reasons aren't much new, you know, when it just comes to the challenges that miners face in terms of safety stoppages, strike stoppages, the depth of South African mines, and all of that playing a role in the numbers. And we're seeing it, you know, that we're not seeing much more new coming into the market and affecting these numbers.
Yeah, absolutely. You know, I guess as you mentioned, you know, they are mining at depths, at great depths, and you know, it's not getting easier. Each year, you know, you can actually see when you look at the reserve statements of these companies, they are under pressure, and obviously each year they eat out of that reserve base as they obviously mine, and with that they got to develop new reserves to actually replace the old ones, and it's just getting tougher. You know, you know, they got to work in areas that's further away from face infrastructure. You know, and its grades is also in many cases a problem. You know, it's a trend I think we've seen over many years of declining production coming out of South Africa, and you can see it when you, as I mentioned, you know, when you look at a company's reserve statements, that those have also declined at the same rate of production. It's actually a very good correlation between the two. So unfortunately, I think it's a structural issue. And you know, maybe you know, we've had our good years. I think you know, gold is you know, from here on, I think it's just going to be on the back foot.
Let's just talk about, because it seems as though since 2006, I think it was, that the US and China overtook South Africa as leading producers when it comes to gold. South Africa used to be a leading producer before that.
Yeah. I know South Africa in the 70s and 80s used to be a substantial part of global gold supply. You know, they've been a very important producer. But you know, as time has gone on, as I said, you know, they've moved deeper levels of mining, and it's just getting, you know, with the electricity cost that, you know, that we've seen in the last couple of years, the increases we've seen on that front, you know, makes it very difficult to operate profitably at these great depths. You know, you got to put so much cooling into these deep level mines, and it takes additional labor costs for the people to travel towards the face in terms of you know, the distance they got to travel. So there's many of these structural problems, I would argue.
Let's just talk a little bit about what's happening right next door in Namibia, where we were speaking to a miner earlier on in the year who was just saying that they're not even having to we're talking about open cast mines, where it's really easy for them to extract this gold. So just in terms of competition, having, you know, Namibia right next door to us, what does that mean for South African gold producers?
Look, they have been extracting. I mean, Anglo Gold is in Namibia. They've got a open cast mine there, and you know, there's many others that are obviously also mining on that front. I think on many open cast mines, what you do see sometimes is the grade is unfortunately lower, and obviously they got to do development, so they got to open it up, and there's a lot of waste stripping that's got to be done as well when they mine those areas. So you know, in itself, I guess, you know, it's maybe a better option than deep level mining, but it all depends on the grade that it takes you, and obviously, you know, a lot of the because that type of mining is very machine intensive, you know, diesel becomes a very important role in their cost inputs again.
Let's just talk a little bit about you know, when we're getting numbers like this, because our previous mining output numbers, gold output, weren't much better than this, and it seems as though, you know, is this a trend that you could see going forward, that with these challenges, when you're talking about structural issues, there isn't much you can do. If the gold is really deep down, you have to go to those depths.
Yeah. No, and we've seen a lot of restructuring happening, especially from Harmony's side, you know, where they've cut their production by quite a lot from the South African mines, and unfortunately, I think, you know, it's exactly that. It's a structural problem. We are seeing on some of the bigger mines from Goldfields, Anglo Gold, and Harmony that their reserves are under pressure. They find it more and more difficult to replace the old reserves again, and you know, I think many of these mines are running to sort of the last, say, 7 to 10 years of their life,
which is not much. So when you're talking about investor confidence, do you think that these miners would probably, I mean, you've talked about some gold producers that are, you know, in other countries right now. Do you think that perhaps they are going to have to start looking at other reserves outside of South Africa to be able to continue holding on to that investor confidence?
Absolutely, you know, and they've started a couple of years ago, and they've made intend very clear that they want to expand on the borders outside of South Africa, you know, and we've seen many of them, you know, Harmony Gold, I guess, was the latest one that moved on their Wafi Gold project in Papua New Guinea, which is a substantial resource body, and you know, that's a great project for them, and that will diversify their exposure massively away from South Africa once that mine comes into production. And the other two miners, I mean, Gold Fields and Anglo Gold, you know, if you look through the annual report and you read where all their money is going, most of it is going on areas outside of South Africa, unfortunately. But you know, it's just the way it is. I would argue in a tough environment.
Unfortunate for South Africa, but for the investor, they're saying, well, we want to go where the money is, and so they would probably stick with those companies. But let's just talk about the impact that would have on South Africa with these miners, you know, looking more and more outside of the country, what that would mean for employment here and for just other opportunities that this mining has for the country.
We've seen, you know, a lot of the workers that used to work in the deep level gold mines has actually been employed by the platinum mines as they restructured a lot of these shafts and mines. So we've seen actually a shift over to platinum. But you know, on the current front as well, I would argue, you know, the platinum side as well, one can't really see massive growth or massive expansion, you know, in the next couple of years, where you would necessarily see a lot of maybe the people that's working in the gold environment can actually move over and that to continue. You know, other areas where we are seeing improvements is coal and iron ore, where our infrastructure is improving. Chrome, you know, there's a couple of the other minerals and commodities, I guess, where a lot of these workers can be utilized. But it is a problem, you know, it's a problem for employment.
I want to talk a little bit about uranium, because that seems to be like a point of interest for South Africa. Do you see that happening anytime soon?
Yeah, I mean, it's one of those, I guess, you know, one can see the demand, you know, in the future. One can, I mean, you know, the Chinese has been very clear on this, you know, that their future power stations will be nuclear by nature. But I think the accident that we've seen in Japan, the earthquake, and the consequences it had on their nuclear power station has put a lot of projects, pushed a lot of projects a couple of months back, maybe 2 years or even more. And on the back of that, maybe you are seeing a slower demand, maybe on a shorter to medium term on a uranium. But longer term, you know, the fundamentals looks pretty good.